Winnebago just dropped a bomb on the R-vee market, and dealers are losing it. Leaked invoices just revealed what they actually pay for those shiny new R-vees, and the profit margins will make your jaw drop. We're talking markups of $20,000, even $30,000 before the upsells, before the discounts. It's the kind of leak that exposes the entire pricing game, and dealers are calling it the end, because once you see these numbers, you'll never pay sticker price again. Here's what they're hiding. Dealer cost exposed. It started quietly. A handful of screenshots shared in an R-vee forum showing what appeared to be factory invoices for brand new Winnebagos. At first, most viewers assumed they were fake, but then the serial numbers matched public VIN records, and the truth began to spread. These weren't marketing materials or dealer estimates. They were the real invoices, straight from Winnebago's internal billing system, stamped, signed, and dated. Each sheet revealed what the dealer actually paid for units that were later listed tens of thousands higher on public retail sites. One invoice in particular, for a 2024 Winnebago Travato 59K, showed a factory invoice cost of $126,400. That same model, on the dealer's own website, was priced at $149,995. For years, consumers assumed dealer profit was thin, maybe 2 or 3%, but this leak proved otherwise. The markup, before a single add-on or warranty upsell, was already well above $20,000. That discovery hit hard because it confirmed what skeptical buyers had suspected for years. Retail pricing was not just inflated, it was structured to hide multiple layers of hidden margin. For the average buyer, this wasn't about curiosity, it was about fairness. How many families stretched their savings for a discounted R-vee that was still priced $15,000 above dealer cost? And how many more were told, "We're barely breaking even," while financing those markups over 10 or 12 years? But that invoice was only the beginning. The real money hides below the line, the hidden margin. Once the invoices began circulating, financial analysts and R-vee enthusiasts started comparing them to retail pricing sheets. That's when the second shock landed. Even the so-called invoice price wasn't the full story. Dealers don't simply pay the invoice and mark up from there. Hidden underneath are manufacturer incentives, freight kickbacks, and something called holdback, a 2 to 3% payment from the manufacturer returned to the dealer after the sale. Take that same Travato example. On paper, the dealer paid $126,000. But in reality, Winnebago later reimbursed roughly $3,000 in holdback and another $1,500 in freight assistance. That meant the dealer's true net cost was closer to $121,500. So when that same R-vee sold for $150,000, the profit margin wasn't 10%, it was closer to 23%. Even smaller models like the 2024 Winnebago Solus Pocket showed similar gaps. The invoice listed $89,600, but with holdback and factory rebates, the dealer effectively paid around $85,000. Yet listings online showed buyers paying $99,000 to $102,000, a $17,000 spread on a van that had been marketed as tight margin. It became clear that the invoice is a stage prop, a number designed to look official enough to convince buyers they're getting close to dealer cost. The reality is that the system is layered with off-book credits and hidden reimbursements that inflate retail margins while preserving the illusion of transparency. Those fees aren't the dealer's cost, they're the dealer's cushion. If you think dealers have been hiding too much for too long, hit like and drop a comment of how much profit do you think they're pocketing. Floor plan pressure. The next revelation didn't come from Winnebago at all. It came from the lenders. Dealers don't pay cash for the hundreds of R-vees lined up on their lots. They finance them through what's known as a floor plan loan, essentially a revolving line of credit tied to each unit's VIN. For every day a rig sits unsold, the dealer pays interest. In normal times, that cost is manageable. But when interest rates jumped over the past 2 years, that quiet expense became a crushing liability. Documents from one regional lender show the math clearly. A dealership carrying 60 units valued at an average of $100,000 each owed nearly $6,000 a month in floor plan interest alone. After 6 months of slow sales, the total holding cost per vehicle had climbed beyond $3,000. Add insurance, site costs, and marketing fees, and the margin begins to erode quickly. This is where panic begins. When inventory doesn't move, the interest clock doesn't stop. Dealers are forced to choose between paying those costs or slashing prices to free up credit. That's why, in the past 90 days, we've seen price cuts across the Midwest, averaging 12 to 15% on older models, not out of generosity, but out of necessity. And when those loans come due, markdowns aren't optional, they're survival. The inventory pileup. Drive past any major R-vee lot this month, and you'll see the pattern with your own eyes. Rows of unsold Class C motorhomes stretch across overflow lots. Brand new models parked fender to fender, some untouched for nearly a year. Drone footage from Iowa and Florida shows hundreds of units, packed so tightly that delivery trucks can't even maneuver between rows. This is the direct result of what you just learned: inflated markups meeting floor plan pressure. Dealers ordered aggressively in 2023 when demand was still strong, expecting a post-pandemic boom that never came. Now, with consumer confidence down and lending rates high, those bets are backfiring. In the last 30 days alone, online inventory trackers show dealer listings for new Winnebago Class C rigs increasing by almost 20%, while retail searches have dropped below their spring levels. That imbalance creates a perfect storm: too many units chasing too few buyers. Every month they sit, those same floor plan fees chip away at profit until the only option left is liquidation pricing. Now let's talk about how panic pricing starts spreading across the map. Forced markdowns. By mid-summer, the whispers about markdowns were no longer rumors, they were memos. Screenshots began to circulate from internal dealer bulletins labeled confidential, showing factory-to-dealer incentives designed to clear 2024 Winnebago inventory before the next financing reset. These weren't public promotions or end-of-season sales, they were private, targeted rebates of up to $10,000 per unit, paid directly to dealerships who agreed to move age stock before September's floor plan renewal date. One memo from a regional distributor in Indiana spelled it out clearly. Immediate incentive applies to all 2024 Class C models held over 180 days. Units must be retailed or auctioned by September 15th to qualify. In plain English, that meant dealers had roughly 6 weeks to liquidate aging inventory or risk losing the bonus, a financial hit that could erase most of their profit for the quarter. And that's when the price cuts started to appear. In the span of a single week, several Midwestern dealers quietly slashed listings by $8,000 to $12,000. To the casual buyer, these looked like generous summer savings. But to anyone reading between the lines, it was obvious. The markdowns weren't generosity. They were survival math. Every reduction was offset by factory kickbacks, meaning the dealer stayed whole while the illusion of a discount drew in new buyers. But that deal isn't charity. It's a warning signal. The interest rate trap. Behind every markdown is a loan clock ticking louder by the month. Floor plan financing, and the invisible lifeline of every R-vee lot, has turned into a financial chokehold under today's interest rates. 2 years ago, the average floor plan rate hovered around 4%. Today, many dealers are paying between 8 and 10% annualized. That might sound small, but across millions of dollars in inventory, it's the difference between breathing room and panic. A Florida dealer recently explained it bluntly in an industry call. "We're paying almost $9,000 a month just in interest on stock that's not moving. Multiply that by 12 months, and you see why dealers are desperate to sell. That cost eats directly into the markup margin, leaving less to cover overhead or payroll." Each unsold Winnebago sitting in the lot is not just metal and fiberglass. It's a liability accumulating hundreds of dollars in financing charges every week. Dealers can try to mask it with incentives, loyalty programs, or flashy ads, but the math doesn't lie. When borrowing costs rise faster than sales, desperation follows. And that desperation is what creates opportunity, if you know how to recognize it. Those rates are turning inventory into a ticking time bomb. Auction dumping begins. The next stage of panic doesn't happen on the sales floor. It happens at the auction block. When dealers realize their lots are overstocked and floor plan renewals are days away, they turn to wholesale auctions to offload inventory fast. Normally, this process is invisible to the public, but leaked auction sheets from late August show a pattern no one expected: nearly new Winnebago units being sold below invoice. At a Kansas liquidation, a 2023 Winnebago Adventurer 35F with a $172,000 invoice sold for $154,18 below cost. In Texas, a 2024 Mini Winnie dropped from $104,000 to $92,000. This kind of dumping signals true distress. Dealers don't auction below cost unless the carrying expense has become unsustainable. Every unit sold that way resets the market lower, creating a ripple effect across retail pricing. When consumers later see the same models discounted on dealership websites, it's often because auction comps have forced them to follow suit. If auctions are already this low, imagine what hits retail next. Proof of the panic. By early autumn, the markdown trend became impossible to ignore. Analysts tracking dealership listings noticed a steady decline across multiple states. In just 30 days, the average advertised price for new Winnebago Class C models fell from $122,000 to $109,000. That's a $13,000 drop in a single month, the fastest retail adjustment since 2019. Side-by-side screenshots tell the story better than any press release. One dealership in Ohio listed a 2024 Solis Pocket at $98,995 in August. By September 15th, the same unit, same VIN, appeared at $87,900. The photos were identical, only the urgency had changed. Another dealer in Arizona dropped a View 24D from $171,000 to $158,000 within 3 weeks. The only caption added was "motivated pricing." This is what panic looks like in slow motion, an industry adjusting its numbers to stay afloat without admitting defeat. Dealers will call it market alignment, value repositioning, or seasonal clearance. But behind those phrases lies the same truth. Floor plan costs, factory rebates, and auction losses have converged to squeeze margins thin, and yet, some models are still overpriced, for now, timing the collapse. If the first half of this story was about panic on the dealer side, this part is about timing for yours. Every dealership runs on cycles, not seasons but financing schedules. Floor plan loans don't renew once a year. They roll over in 30-day segments tied to inventory aging reports. When a unit crosses 90 or 120 days unsold, the interest cost spikes, and the lender begins to pressure the dealer to move it. For most lots, that reset happens at the end of each quarter, and that is where opportunity hides. Imagine this. A 2024 Winnebago View that's been on the lot since spring now costs the dealer almost $1,000 a month just to keep. By the time autumn arrives, the dealer has paid $4,000 or $5,000 in interest alone. Multiply that across 30 or 40 units, and you begin to see why markdowns appear in clusters, not randomly, but right before those reset dates. Dealers slash prices to avoid another month of compounding costs. The next 30 days matter most. Late October to mid-November triggers major lender resets. Step onto a lot then, and you're bargaining with time itself. Each passing day tightens dealer pressure, turning every limited offer into your window of leverage. Knowing when to buy means little unless you also know what you're buying and what it truly costs. Model by model decoder. To make sense of the chaos, you need real numbers, not estimates, not rumors. That's where the dealer cost decoder comes in. It's a chart built directly from verified Winnebago invoice data, showing factory costs, holdbacks, and average retail pricing by model line. Once you see the spread, you'll never look at a special price the same way again. Start with the 2024 Winnebago Travato 59K. The factory invoice on this van sits around $126,400. The current average retail listing nationwide is $148,600. After accounting for holdback and freight credits, the dealer's true cost is closer to $122,000. That leaves roughly $26,000 in usable negotiation room, even before any manufacturer incentives apply. Compare that to the Winnebago Adventurer 35F. The invoice is roughly $172,000. Listings sit near $193,000. Yet holdbacks cut real cost to $165. Even at $180, dealers quietly pocket $15,000 in profit. But the biggest surprise hides in the Class B line. If this breakdown helped you see the truth behind the prices, subscribe now. The next leak's coming soon, and you'll want to see it first. When used beats new. The leak didn't just expose dealer pricing on new rigs, it also revealed how fast those same models depreciate once they're sold. For buyers who think new guarantees value, the numbers say otherwise. Within the first 12 months, the average Class B Winnebago loses between 15 and 20% of its retail price. That means a $150,000 van can be worth as little as $120,000 within a year, often less. Meanwhile, used models purchased at auction or through direct resale have already taken that initial depreciation hit. A 2-year-old Winnebago Solus that originally retailed for $95,000 can often be found today around $75,000, a $20,000 savings that's mostly front-loaded depreciation, not mechanical wear. The powertrain, the shell, and most interior systems remain nearly identical. The shift in value dynamics is driving more buyers towards certified used and dealer trade-in stock. It's not about age, it's about timing. As auctions swell and demand cools, dealers slash late model used prices below invoice just to survive. Once you understand why used often beats new, the next step is learning how to turn that knowledge into leverage, negotiation from their side of the desk. Here's where knowledge turns into leverage. Once you know the dealer's cost structure, you can build your offer from their side of the table instead of yours. Start with the factory invoice number, subtract the typical 2 to 3% holdback, and deduct any manufacturer incentive currently active. The result is the dealer's real break-even point, the number they rarely admit. If, for example, the invoice on a 2024 view is $140,000, and the holdback plus incentive total about $6,000, the dealer's true cost is roughly $134,000. That's your baseline. You can safely offer 2 to 4% above that figure, say $137,000 to $139,000, and still give them profit. The difference is you're controlling the math, not them. Never lead with emotional language like best offer or budget. Lead with precision. I've seen the invoice on this model. I know the margin room. Let's start with the real number. That single statement resets the conversation. It signals you're not guessing, you're informed. And once they realize you understand holdbacks, rebates, and floor plan pressure, the bluffing stops. And if you think dealers hate that tactic, you're right. What dealers do. Next, the dust hasn't even settled, and already the industry is rewriting its rules. Across the country, Winnebago dealers are quietly adjusting their playbooks for 2025. Expect smaller orders, leaner inventories, and tighter credit agreements. Many dealerships that once stocked 60 or 70 rigs are scaling back to half that number. After the panic of the last quarter, few are willing to carry unsold inventory into the new year. Manufacturers will follow suit. Winnebago insiders say new production runs will focus on fewer trim variations and more flexible build slots, a direct response to the oversupply that crushed margins this year. But here's the twist. Smaller orders don't mean higher transparency. In fact, it often means the opposite. When inventory tightens, dealers use scarcity as leverage, pushing urgency and implying shortages to justify price floors. The game doesn't disappear, it simply shifts shape. Lenders are inventing lifelines to keep dealers afloat. Longer floor plan grace periods and incentive-linked loans that disguise debt as recovery. It looks stable for now, but once those temporary fixes expire, the same financial pressure will surge back stronger than before. That's their playbook, but you've already seen the pages. Protecting your wallet in 2025. Now comes the part that matters most. What you do next. 2025 will be a defining year for R-vee buyers because transparency and timing will finally align. The best deals won't come from sales events or dealership ads. They'll come from informed timing and real verification. Here's how you stay ahead without getting caught in the next cycle. Skip the early year hype. January and February bring floor plan resets and margin recovery games, pushing prices up. Wait for late March or April, when 90-day inventory pressures hit and quiet markdowns begin, not as sales, but as dealer survival tactics. Second, always verify invoice data before stepping into a negotiation. Tools that expose factory-to-dealer pricing are your compass. Don't rely on printed dealer cost sheets handed to you at the lot. Cross-reference VN data with public records and leaked sources like the Winnebago invoice samples you've already seen. When a salesperson quotes an all-in cost, you'll know exactly how much margin sits underneath, because the next reset hits sooner than anyone expects. The transparency shift. Something fundamental has changed, and not just for Winnebago. The invoice leaks that began as whispers have triggered a quiet revolution in how buyers share and verify information. Online communities, once fragmented, are now exchanging screenshots, dealer memos, and VN data in real time. This isn't just gossip. It's the beginning of open pricing in a historically closed market. For years, dealerships thrived on information asymmetry. They had the ID and numbers. Buyers had trust. Now that wall is cracking. Leaked invoices expose hidden margins, and manufacturers are scrambling toward transparent pricing because secrecy can't survive in a world where proof travels instantly. This shift empowers the very people the system underestimated: cautious, detail-oriented buyers who verify before they spend. Every screenshot shared online weakens the walls that kept retail pricing opaque. As the data spreads, the entire market inches toward accountability. And the more buyers share data, the faster the old system cracks, the smart buyer's edge. This story began with a leak, but it ends with perspective. You now understand what dealers pay, how their financing traps work, and when the timing tilts in your favor. That's not just information, that's insulation. It protects your wallet from pressure tactics and false urgency. It also gives you something dealers rarely face: patience backed by proof. The real edge isn't being aggressive, it's being certain. You know that floor plan resets every quarter. You know that factory rebates create false discounts. And you know that inventory pressure always produces opportunity. When the next wave of markdowns hits, you won't wonder whether prices are fair. You'll already know how far they can fall. Here's what that means for the coming month. The next floor plan renewals roll in just 3 weeks from now. That's when cash-strapped dealers will once again face the math they can't escape. Watch the listings around that time. Prices will soften first on Class C models, then ripple out to Class B vans. When you see the first $5,000 drop on a unit you've been tracking, that's your signal. So now you know exactly what's been happening behind those dealership doors: the markups, the leaks, and the panic. The next few months are going to get wild, and if you want to stay ahead of it, you'll want to be here when the next leak drops. Hit like if this helped you see the game for what it is. Drop a comment with what you've seen at your local lot, and subscribe so you don't miss what's coming next.